Let's see. Yep. Looks like we are live. Guys, I don't see anything saying we're live here, but if you guys see me, if you guys can hear me, why don't you go ahead and put a 1 in the chat? I'm not even sure if the chat is activated here. It's been a while since I did the Market Mastery class. Make sure I'm live. All right, I'm live. Thank you. All right, welcome. Greetings, everybody. This is Crypto Picasso. I'm the master trader educator for Swipecoin cryptocurrency. I get into some charts here today with everybody. Hopefully everybody's doing good. Whether you're quarantined, self-quarantined, hopefully everybody's staying safe and healthy. Definitely some crazy times we're living in right now. I see you, Roman. What's up? Right. I'm going to give it a couple minutes for everybody to jump on. I'm looking into some of these charts, what I see here going on for Bitcoin. I want to talk not just about Bitcoin on this session, but I want to talk about basically how to master these markets, right? This is the market mastery class. So I've been trading for 12 years. This is 7 years just trading Bitcoin. So there's some things that I've done wrong along the way, and there's some things that I've done that have made me be successful at trading. I really want to try to give you guys as many nuggets on this session as possible because trading is the same. It doesn't matter what market you're trading. Trading is it's just like reading a language of human emotion. So once you understand a couple key things and what to look for, you can apply that to whatever markets you want to trade. For me, I just stuck to Bitcoin and cryptocurrency because I found them to be the most profitable for my trading style. All right. Can't see how many people are on this session here, but I'm sure we got quite a few. All right, guys, I'm just going to give a couple more minutes here, just about 3 more minutes, let people jump onto the session. All right. France, China, Polish team, Delaware, Cape Town, Poland. Right. These are definitely the times to be learning a new skill. I mean, I would say now more than ever, it's important to learn how to become in control of your own finances, how to work from home, how to work from your phone. These are really important skills to learn going forward. I mean, honestly, I'm seeing a lot of people that I've known I've been trading for 12 years, and during that time, most of the people that I knew stuck with traditional jobs and stuff throughout their lives, and they would always look at me a little crazy for risking my money to make money, um, and being not relying on having a job, right? Being self-sufficient and independent. And now a lot of those people are out of work, and they're asking me to show them how to trade. So it's definitely come full circle. Like it really comes back to self-sufficiency. Like we really want to be able to not be reliant so much on the system, guys. Hopefully everything comes good in the next couple months. We get over this virus thing soon, but honestly, I feel like from my studies in global macro trends and economics and what's going on, we're definitely reaching a point in time now where things are changing, right? Things are changing. Second. New York, Queens, Michigan, Montreal. All right. Yeah, so things are changing, guys. This is definitely a time to recycle what you got, to invest what you have in things that have utility, not vanity. It ain't the time to go out and buy a new watch and a new belt and try to, look look good to your peers and stuff like that, because things are going to get crunchy, guys. Like, people are going to be out of work. You want to invest in things that you can recycle, that have utility, to to bring you the most important things in life, as you go forward and have a family: food, clothes, shelter. All right, those things are extremely going to be important coming forward. And to learn how to provide in this environment, you have to really be able to learn a skill. All right, whether it's marketing or something to do online. We are in a digital age, so learning how to trade and to read these markets is extremely important going forward. I can't stress that enough, because I'm already seeing it in my experience. Right, everybody who really wasn't interested in what I was doing for 12 years is really interested now in what I'm doing, and how they can potentially do it going forward. So I'm going to show you guys some things to master in these markets, kind of shortcuts, right? It's quick little things to understand and how the market works. Because I'll tell you straight up, 80% of people who trade fail. All right, 80% of people who trade fail. All right, about 12:06. All right, guys, I'm going to jump in the charts here. So, understanding what's going on in the world and in the market. Let me just clean some things up off my charts here. Get like a higher time frame here. Go back to candles. We'll get into all this in a second. All right, so I got Bitcoin up here on my chart, higher time frame chart, 3-day chart. Now, understanding what Bitcoin is and how Bitcoin is important in this environment and as we go forward. Bitcoin was born out of a recession. Okay, as we came out of 2008, the 2000, like everything that was wrong with the system, in a sense, Bitcoin was created to be to serve better utility than cash and anything that was controlled by a central government. So now's the time that Bitcoin really should come into its purpose, right? Where people should actually see its utility. But what's going on is that, and what I've noticed in the market is that when we look at Bitcoin over the last, let's just pull it up on like a weekly even, over like the last 10 years, right? Bitcoin has been the highest performing asset class in the last 10 years by far. But during that same time, the stock market was also doing pretty good. All right, the economy, the U.S. economy. Let's look at the U.S. 30. You guys are more familiar looking at the U.S. 30 chart. Okay, let me pull up a weekly chart as well. Oh, sorry, this is inverted. Okay. So basically, as the U.S. economy and the world economy is doing good over the last 10 years or so, let's pull it back to about the same period of time. Okay, Bitcoin is also doing really good. Okay, during this whole stretch of the last decade, Bitcoin being the highest performing asset class. Now, as the U.S. economy here took a hit with this coronavirus, this is what we call in the trading world a black swan event. Basically, something that your analysis doesn't really point to. It happens quick, it happens fast, and then it changes, trend, or changes the dynamics of the market, or it creates conditions that were previously not as calculated for. When you're trading, you always want to not only trade with money you can afford to lose, and you always want to understand that there's risk, right? But there's calculated risk when you're trading and investing all the time. The market just falling out like that fast, that's like what's considered a crash or a black swan event, something that wasn't calculated for to happen with such probability, in a sense. But how that affected Bitcoin was Bitcoin took a hit with it. Okay, so when the stock market sold off and everything sold off, Bitcoin took a hit with it. Now, a lot of people recently have maybe lost faith in Bitcoin because they're like, all right, well, Bitcoin was supposed to protect me from all this, right? Bitcoin was supposed to be our lifeboat from the crashing economy or whatever. So, but you have to realize the way that the markets work and where Bitcoin's position is in all of that as the dust kind of clears here. Okay, when Bitcoin went on its last parabolic rise in 2017, okay, up to 20,000, it retraced all the way down to about $3,000. Okay, during this time, basically since then, since about late 2017, 2018, that's when more legacy legacy players is what I call them, but more traditional market traders got involved in Bitcoin. Now I'm talking Wall Street, investment firms, hedge funds, big money, like real institutional money and mainstream money, not the usual Bitcoin crowd, okay, started investing more in Bitcoin around here in 2017, 2018. So that was pretty well known through articles and news and people coming into it. So what we have is a situation where a lot of big traditional money got into Bitcoin, had a lot of exposure to the Bitcoin market. So when something like this happens in the traditional market and everything just basically melts down, and melts down fast, it creates what's called a risk-off environment, like where basically everybody just wants to get out of whatever they're in and have no risk and just get back to the dollar, basically. The dollar is perceived as the safe haven, right, for the last 100 years or whatever. So the idea is the traditional markets start to crash. The investors that have their money in Bitcoin are forced in a position where they need to liquidate everything and just take risk off of the table. What that does is it creates a situation where Bitcoin also had large orders selling out when the traditional markets were crashing. So that's why Bitcoin took a hit because all the people that own the market, they needed to just get back to the dollar, get back to being in a risk-off environment, no risk. They're not taking on risk. There's two different types of trader and investor mentality. You're either taking on risk or you are trying to get out of things and get out of risk, trying to off risk. So we had a huge off-risk event where it caused liquidations and cascading liquidations where the price just could continue to drop, pushing Bitcoin to levels that make sense when you look at it afterwards as far as Fibonacci and different structure of the market, but the timing of it was not calculated in any analysis, really, unless you're really looking at those price points being revisited as far as a bigger range. But as far as the trend, it took Bitcoin off of the initial trend that has been going on for a while. And that trend has been where Bitcoin gets aggressive in its price action before the mining reward gets cut in half. So just to keep it short on the mining thing, computers mine Bitcoin, which means they have their computer power try to solve a formula to earn Bitcoin, and that Bitcoin has to and mining is profitable. Only profitable if the market value of Bitcoin is a certain amount. So those miners get a certain amount of a reward every day by the new Bitcoin that comes into creation. Well, that reward gets cut in half every 4 years. And so we're about 2 months away from when that reward gets cut in half. So what's going to happen is in the next 2 months, the amount of Bitcoins that the miners get every time that they solve a block in the algorithm, it's going to be half. It's going to be cut in half. So there's going to be less supply coming into creation. So the market usually adjusts for that by going up in dollar value. Because Bitcoin, there's a limited supply of these things. Okay, 21 million Bitcoins. So when less come into creation, the market usually adjusts and goes up. And that's what creates these big moves in Bitcoin over the last basically 10 years. As the mining reward gets cut in half, the market goes through new supply and demand, basically mechanics that are going on, like the supply and the demand ratios, and the price starts to go up, and the traders, they chase the price, and it creates a cycle, okay? Bitcoin creates a cycle. every, let's put here, okay, a cycle like this that you see just about every 4 years, even into back here. Okay, these cycles that are actually emotional market cycles. Okay, so as Bitcoin starts to go up in price because there's less supply coming into creation and the supply and the demand dynamics have changed, the price starts to go up and trends, and it starts to bring traders that push the price through this emotional market cycle that pushes the price to exponential rises in price. I mean, Bitcoin has gone, from hundreds of dollars to thousands of dollars, and I really feel like still within the next couple years, Bitcoin's going to be within the hundreds of thousands of dollars. So we're at a point now where what Bitcoin was created for is really starting to play out in our society. Like, we're getting to a point where people are going to not want to touch cash. People are going to want to use digital methods of payment. We're getting to a point where the US government and many other governments are going to just completely print more money and print more money, which is going to lead to more quantitative easing, lead to hyperinflation, lead to devaluing the currency. Bitcoin is like, basically investing in Bitcoin now is like betting against the US dollar for the future, knowing the path that the US dollar is taking, in a sense. So Bitcoin now is getting ready, I feel, to push into a new cycle, but how it needs to trigger itself. Like, I feel like all of this that happened here, this got in the institutional money, and now it washed out a lot of the institutional money. But nothing's changed for Bitcoin. Bitcoin should still continue to trend up over time. Okay, and like, more people are, there's more wallets with one Bitcoin in them. The network, the hash rate is growing. All of these things, like the network itself, is growing. So nothing's changed about Bitcoin. I feel like in the long term, these prices are going to be phenomenal prices to buy at. But right now, the environment is fear, basically. Everybody's been scared out of every market. Global markets are melting down. There's a lot of uncertainty in these markets. Okay, so I'm still investing in Bitcoin for the future because I really believe that the only way to make money that I've found is to buy the fear and sell the greed. Buy the fear, sell the greed. Understanding that the market is full of cycles of emotion. Okay, and not just Bitcoin, but all markets. All markets are filled with cycles of emotion. So understanding that when others are fearful, it's a time to actually be investing. So understanding that, I'm still investing in Bitcoin for the long term, for the future. I still feel like nothing's changed fundamentally for Bitcoin. I just feel like it now has to show itself. It now has to show itself as far as the utility it serves. And the rest of the system in itself everything needs to run its course, in a sense. Like, we see what's going on now with everybody's idea of to get out of everything, right? When everybody got out of their stocks and got out of their investments and got out of everything, what did they do? They went back to the dollar, right? So what happened to the dollar? It's very important to understand global macroeconomics on all markets and how that's going to affect Bitcoin, because now is Bitcoin's time to shine in all of this. And it's time to decouple from the stock market. And it's time to actually show strength against the US dollar. So let's look at a couple things real quick, and then I want to break down a couple like mindset things and strategies as far as like understanding what kind of trader you want to be, because that's super important. Let's look here. Okay, so let's look at it on the daily. Okay, so when everybody sold out everything, what happened to the dollar? Surged, right? Dollar index went up to almost $1.04. Now it's retracing to basically the breakout levels. Okay, but understanding all of this is how you to understand it when you're trading forex, or you're trading gold, or you're trading the stock market, or you're trading Bitcoin. You really need to understand a little bit of the relationship of what where's people's safety of interest, right? Like what do people feel safe investing in one thing, or are they going to try to go back to the dollar, let's say? Like what's their exposure to the market? When everybody wants to get out of their investments and get back to the dollar, what does that do to basically forex pairs that are paired against the dollar? Okay, so let's look at this here. Like this is basically the dollar here. I'm going to pull up another chart here. It's just a weekly here. Let's pull up the daily. Come on, get that off. Okay, just to start with this. Okay, I'm looking at the dollar index at the top, and I'm looking at the stock market at the bottom. Okay, it's both a daily chart. I'm going to line up the time frames right about there. Okay, so as the stock market breaks and goes down, and everybody wants to get out of their investments, the dollar index rises. Okay, so these are things to keep in mind, like what markets to trade, where's the money flowing, what looks strong, where are trends, like what is starting to form a trend. Like if we continue in this way and this virus continues to create fear and uncertainty and doubt in the markets, the dollar is going to find strength here and it's going to continue to go up. Okay, like it pulled back now, but just to understand how one thing affects the other, right? Because everybody trades within IM Academy. Everybody trades different things, right? I'm the crypto guy, but before I traded crypto, I traded everything else for 5 years. I just never went back to those markets because I find cryptos more profitable for me. I can read those charts consistently, right? But understanding what's going on with the global economics in the world is super important because to understand where the money's flowing. Now let's look at this. As the dollar is going up, let's look at some forex pairs. Let's look at basically whatever's paired against the dollar. Let's look at the Australian dollar. Okay. Okay, so when people sell out their stocks and people want to get back to the dollar, all right, and the dollar index is rising, what's happening to the weakest basically pairs that are paired against the dollar? Boom, they're dropping. The bottom is dropping out on them. They're breaking their trends. They're going lower. Okay, so these are things to understand. Like these are inverse correlated in a sense. Like if this dollar index is going to go down and the dollar gets strong, almost everything that is paired against the dollar is going to drop. Okay, almost everything is paired, and you can almost, like, for you guys that pay attention to the news and politics, just think about like this: sort it out from the strongest economies to the weakest. The ones with the weakest economies are going to drop hardest against the dollar. Like, to understand the psychology of between how all of this is connected and all of it's flowing is important to know where you're going to catch that trade, because you could be, as you're shorting the U.S. stock market and maybe selling Bitcoin at the same time, you could be longing the dollar and also shorting the Australian dollar against the U.S. dollar, right? Or the same way, so longing U.S. dollar, Canadian dollar, U.S. dollar franc. Let's see, UCAD. Here we go. Boom. When the dollar went up, what did the dollar do against those pairs? It exploded. Okay? So understanding how to look for opportunities in this crisis, you really got to know a little bit about how the money's flowing. Okay? When people want to get off the risk, they want to go back to the dollar. The dollar index is going to grow. Everything paired against the dollar is going to dump. Everything that's where the dollar is paired against, where the dollar's basically in front, for you guys that don't understand, for you guys that are new, basically everything on a Forex pair, all right, that's like USD in the front, if the dollar index is going up, those pairs you're looking for longs. You're looking to buy the pullback, right? You're looking to work that market to the upside. All the ones with that start with the country in the front and the USD afterwards, those things are going to tank. They're going to go down. When the dollar index is growing, you're looking for short opportunities in those. So I'm talking about all this because I know everybody doesn't trade crypto, and I want everybody to understand how to look for opportunity in crisis, because there's some serious volatility in these markets where there's hundreds, if not thousands, of pips like within a couple days here floating around in a lot of markets. Like cryptocurrency is usually this volatile, but now other markets are getting a little bit volatile as well because of the just because of the situation, right? But understanding what created that situation, we have the coronavirus, right? We have this uncertainty, this fear, this stress on the economy. People want to get out of the risk. They want to go back to the dollar. Things that are paired against the dollar are going to get weak. When the dollar's paired, things that are where the dollar's in front, they're going to get strong. So that leads us back to Bitcoin, right? Let's look at this. I want to go back over here to majors, silver. Let me go back to one chart here. Actually, I'm going to go back to two charts just to compare it, and we'll look at the dollar index on the bottom. So everything else, after that initial sell-off, okay, everything else that was paired against the dollar continued to decline. BTC paired against the dollar actually started to stabilize, and actually started to stabilize where as more than the stock market in a sense. So Bitcoin at this point in time, when everything else paired against the dollar showed weakness, Bitcoin actually stopped selling off and didn't go any lower and started to stabilize and started to show balance of price. Okay. And let's just talk a little bit real quick about what kind of trader you want to be like, because I feel like that is something that not many people talk about. And there's so many markets to trade. There's so many different techniques and different ways that you can trade. I really want to spend just a couple minutes explaining to everybody that that's really important to decide what kind of trader you want to be, because you can be a swing trader. Like for me, I swing trade because I have found over the years that I get the best risk to reward setups without having to have my head in the markets and be obsessed with the markets. Like I don't have to be trying to find a trade every day, and I don't have to be worrying about what the price is doing every single candle. If I'm a swing trader, because I'm looking for the bigger moves the market makes, and I'm looking for good risk to reward setups. So the key things that I would say that need to define what kind of trader that you are to be what kind of what kind of risk do you feel comfortable with, right? Do you feel comfortable, like we call it an R1 setup or R2 setup or R3 setup, whatever, like your risk to reward. So meaning like if you're you need to think about this before you get into every trade. Now for Swipecoin and different stuff like that, I'm not sure about the other products. Like I always have the risk to reward calculated in my trade setups, but you don't always want to follow somebody else's lead. You want to train yourself on how to do this all the time. So you want to understand risk to reward. So if a risk to reward setup of 1-to-1 would be you're risking $100 to make $100, just to keep it simple, right? You're equal. You're risking 100 to gain 100. A risk to reward of 1-to-2 would be you're risking 100 to make 200. 1-to-3, 1-to-4, you get the picture, right? I look for setups where I'm maybe risking $100 to make $300 or $400, right? Like 1-to-3 or 1-to-4 setups. But to do that, I need to swing in and out of the market, and I need to not pay attention to all the noise of the market. And when I say the noise of the market, it means all the little ups and downs, Like, so to be a swing trader, I'm getting a better risk to reward out of the market, but I have to be patient. I have to maybe wait a couple days for my trade to work out. And in the meantime, I may have a little bit of drawdown, and I may be up one day and I may be back down the next before I reach my goal. But I try to stick to the plan and try to get the best risk to reward setup. So if I'm going to risk 100, I'm trying to get 400 out of it. But there's some fluctuation in there. It's not just, oh, let me choose the 1 to 4 setup, right? You have to stomach some certain things in between where maybe you're up $150 one day and then all of a sudden you're only up $20 and you're like, oh, I should have taken that profit, right? But that goes back to what kind of trader you want to be. If you can't watch your balance fluctuate without feeling like you regret something, then you probably shouldn't be a swing trader. You probably shouldn't hold a trade for more than a day. Can you sleep with a trade open? Right? That's another thing. Like, if you cannot sleep with a trade open, you are most likely have too much risk on the table. Right? You should be able to casually take your trade and casually take your loss if you're going to take your loss without worrying about the market every tick of the market. So you really should understand yourself, right? Like, biggest part of trading really is knowing yourself, knowing your discipline, your patience, your risk management. All of these things are so crucial. But you also have to understand, what do you expect from the market? Can you hold a trade overnight? Can you hold a trade for 3 days? Can you hold a trade for 3 months? Can you invest in the market and hold it for 3 years without feeling sick every time the price drops 10%? So these are all things to understand how you're going to define your trading style, right? If you don't feel comfortable with all those things, you don't want to sleep in a position, you'd rather go for a 1-to-1 setup, maybe 1-to-2, than day trade, right? You try to get in that day, out that day, maybe take your $100, make it $200, maybe $300, right? But on those situations, you're really never going to catch that 400 to maybe 1,000, that 4x to 10x. You're never going to really catch that because you're just in and out, right? You have to understand is that what you like, right? Does that define your style? So then you're getting in and out for the day. Your risk to rewards are probably going to be smaller. Do you just want to do high frequency and just get in and out with the bag in 5 minutes, let's say? Is that, do you enjoy that type of trading? But if you do that type of trading, then you actually have the worst risk to reward, where you're, let's say, risking $100 to make 60 or make 70. So it's not even a 1-to-1 setup. So you get in and out of the market quick, but your risk to reward is not really good at all, and you have to be consistently winning, otherwise your losses are going to stack up quicker against you. So understanding how you feel comfortable trading is super, super important in your path of learning how to trade. All right, I would say that's the most important thing, because once you get that, then you can say, hey, I'm just going to scalp the market, I'm just going to do high frequency, or I'm just going to do swing trading and take 2-3 trades a week and not worry about what the market does. Let the market work itself out, right? So understanding that, I feel like once you get that, then you start to really become comfortable in the setups you're looking at, the markets you're looking at, and so forth. All right. The next nugget that I would really, really want to stress to everybody is that all markets are the same. Okay? All markets are the same. When we look at these charts, okay, like this is the only reason that I became successful in trading. Once I realized this, is that when we look at these charts, let me get rid of some things here. We'll talk about them in a second. All right. We're looking at, most of the time, candlesticks, right? Okay, and then we have bars, candles, line chart. But what we're looking at here, okay, no matter how you want to define it in any time period, is a game that's being played between the buyers and the sellers. It's an emotional push of fear and greed, recycled over and over and over again in every time frame. It might sound strange at first, but every single time frame that you're looking at, if I'm looking at the daily chart here, I'm looking at what happened in the struggle of fear and greed, but on a higher time frame to create a cycle. If I'm looking at a 1-hour chart, I'm looking at a smaller cycle of the struggle between the buyers and the sellers. So once you understand that, what we're really looking at when we're looking at the charts is we're looking at the print that was left behind by human emotion of fear and greed during that time frame. And so when you start to realize that is really like what puts those prints on the chart is human emotion, fear, greed, buying and selling, the raw impulse of human emotion. So when you realize that and you start to realize, well, what I'm doing here is I'm reading the print left behind by human emotion. I am reading the emotions of the traders, and that starts to create similar structure that you see again and again and again. And you don't only see it in one time frame, but you see it in all time frames. So all trading is a game of fear and greed, buying and selling, and the struggle between buyers and sellers in different time frames. So when you understand that you're reading human emotion, then you start to be able to apply different concepts to it. Like it's like reading a story in a sense, instead of just looking at raw technical data. You have to be able to feel, like understand what the emotions were in the market when the market was there, right? Basically, like this right here, this is not a chart that was made for Bitcoin. This was made for some stock. But these emotions are the emotions that run the market over and over again, where people chase price, they invest at the wrong time, they make decisions from an emotional standpoint, and they take losses based on the decisions that they made at the wrong time. And this is not just a couple people. This is like the majority of people who trade fail. A lot of people fail. Statistically, it's like 80+% of people who trade fail. And what I found out is that I found out the hard way from like 4 or 5 years of losing is that the only way that I started to realize how to win was by recognizing the fault in myself of how I was trading like this. As soon as the price broke out and was going up, I was like, oh, everybody's buying, it's time to buy, right? Oh, it's time to sell, everybody's selling, right? And giving into the emotional reaction to price that everybody else was doing, right? And then it occurred to me that to actually become one of the 10 to 20% of people who are winning, you have to think like the 10 to 20%. You cannot think about the markets like everybody else. You really have to understand that the market is playing out a cycle of fear and greed. The market is playing out a cycle of emotion. And if you can read that emotion, you can understand how to identify it and trade against it. So when other people are greedy, you are getting out. You're fearful. Like, be fearful when others are greedy and greedy when others are fearful. You want to buy the fear and sell the greed. So when everybody else is jumping all in and, they're thinking they're a genius, that it's going higher and higher and higher, you think about getting out of the market because you're reading the emotion is full of a euphoric state where everybody just thinks they're going to get rich. And at the same time, when the market's down in the bottom and everybody hates life and everybody lost money and nobody wants to touch it because everybody's scared and everybody took a loss, that's when the opportunity is to invest and to buy and to get ready to look for technical things to line up so that you can pull a good trade out of there. So understanding that there's a big wheel in motion, right? So the markets are like this big wheel in motion, just churning, just chopping people up and throwing them out. Just like, it's just savage, okay? That's what's going on in the markets all the time. And you have to realize that that big wheel is churning and turning and just eating people and spitting them out over and over and over again. But you want to find your place in it, read it, get in and get out accordingly, and understand how it flows. Basically, you want to understand how it flows. And once you understand how it flows, then you start to really look at the market a little bit differently. You start to actually win more trades than you're losing. You start to actually come up with repetitive market structures that you see all the time. And then those market structures start to have a very strong relationship to Fibonacci, to moving averages, to support and resistance, to trend lines, all of the other things that you that you teach yourself or that you're learning about trading without getting too in depth. Like I will honestly tell you, after 12 years of trading, I don't know how to use half of these things on these indicator lists, and they're not important to me. It was just some indicator that was made by somebody to help them read the market in that way. So you don't want to overcomplicate it. You want to just realize that it's a big wheel turning of human emotion, but certain things do apply almost all the time. And my number one thing that I use on like almost all of my analysis is Fibonacci. And to me, the reason that Fibonacci works is because Fibonacci it's everywhere in the universe. It is the mathematical blueprint of growth and decline. Everywhere, from nature and pine cones and fruit to plants to tidal waves to galaxies to our DNA. It's everywhere. So it's also in the when we're looking at the charts here, we're looking at the print left behind by human emotion. So therefore, we are measuring human emotion with Fibonacci, and that's why it works, because it actually is telling us the extremes of human emotion and human behavior of fear and greed. So I want to break down a couple of things for people here and just show you a couple of things to understand how to apply these things, basically. Okay. Whenever the market's making, like my biggest thing that I'll say is I never chase it. Okay, let's just say the market's kind of cruising around like this and it's either going to go up or it's going to go down, right? Now, when it makes that initial impulse, okay, I never chase it. Never chase it, retrace it. That's always what I'll say. Don't chase it, retrace it. Wait for the retrace of it. It doesn't matter what time frame you're talking about. Just think about it like this. When there is an impulsive move in the market goes from a certain zone and it impulses out, if you chase the impulse, most likely you are going to get washed out on the pullback. Okay? When the market makes a pullback, if the true intention is to go up, it's going to hold and make a higher low. That higher low, okay, is where you would want to buy. Understanding your positioning in there would be from the bottom to the top and looking for a retracement level, usually 50 to 61%, 38%, and a very strong trend. It doesn't matter up and down. If it's a strong downtrend, you're only going to get a 38% pullback. If it's a strong uptrend, you're only going to get a 38% pullback. But the market does breathe. It does pull back. It goes through an impulse of greed and then, well, fear. I bought too late. Let me get out. Or, oh, I'm at a loss. And you would be surprised how many people buy at the wrong time and just bail on their position at a loss without being patient for it to work out. Okay? So you want to always look for places to make money in the market off of somebody else's loss. I know it sounds horrible. It's a horrible way to look at it, but you have to understand that the markets are a cycle of loss. They are a cycle of loss. So to understand how you're going to win in the markets, you have to know where the loss is going to occur. That's why I got good at trading, because I lost for so long. Basically, my story, real short, is I bought Bitcoin, my first Bitcoin, back here in 2013. I bought my first Bitcoin right here. I was trading gold. I had already been trading for almost 5 years. And right here, when Bitcoin crossed $1,000, I was trading gold. I read up on Bitcoin. Bitcoin is digital gold, the utility, the functions, the technology, everything. I knew that fundamentally this is going to be like something great, right? I knew Bitcoin was going to be a big hit. I knew it. And what happened when I bought my first Bitcoin right here? How did I feel? I felt, man, I'm a genius. I'm going to be rich. That's how I felt when I bought my first Bitcoin. I am a genius. I'm going to be rich. This is the best investment ever. And how did I feel when Bitcoin was over here? Pull it over here. How did I feel when Bitcoin was right here? After it dropped all the way down, after I bought it, after it came back up here, how did I feel? All right, good. Man, we just need one more rally, and I'm going to be rich. One more rally, and that investment's going to really pay off, right? So experiencing the emotional market cycle firsthand, it showed me how I had been making wrong decisions for years in trading and making decisions based on chasing price. I think that's the biggest thing, like to understand, guys. Do not chase price, especially on margin. Most of you guys are margin trading because it's MetaTrader 4, right? So it's super important. You don't want to chase price, whether it's up or down. Like let the market impulse and then retrace. Don't chase it. Don't ever chase it. Look for the proper entry off of a retrace. Okay? But understanding how I watched Bitcoin go through this entire cycle all the way through here, and then when everybody else was, angry and depressed, I understood that right around here was a pretty good time to start investing in Bitcoin again. And boy, did it change everything for me in the course of just a few years. Okay, catching a huge wave up like that on a new technology, invest in new technology is life changing. Like literally being invested in Bitcoin changes. If you do it at the right time, it'll change your life financially, 100%. So understanding how all of this flows really led me to develop a strategy where I was like always looking for where's the loss going to occur? Where's the loss going to occur? Even if it's a 15-minute chart, where's the loss going to occur? Where's the loss going to occur? Always ask yourself that. When you go to set the trade, and almost like this, like since the market is an emotional game that is always running, where people are like 80% of people are making decisions at the wrong time. When you're not being a profitable trader, before you learn how to trade, right? Like this doesn't happen to me anymore because I know what I'm doing in the market, and I know, like I do take losses still. Like I'm about 75, 80% accurate, right? So there's maybe 2 out of every 10 trades that I'm going to take a loss because either maybe I got into the market at the wrong time, or the market turned against me and the analysis was off. Most of the time it's timing. But when you start early in the game and you're just kind of chasing price, did you ever notice, I'm sure people are going to resonate this when I say it, did you ever notice that when you trade, you almost are like, the market did exactly what the market did exactly opposite of what I thought it was going to do. It was almost like I made the decision to do it and then the market did the opposite, right? Like I'm sure some people have experienced that because that happened to me all the time before I learned how to trade. Where you make a decision based on emotion and then the market does the opposite, right? So think about that. Like that's very powerful to understand because that's always playing out. Most people are impatient. They're making decisions at the wrong time, okay? So always look for where is the loss going to occur, and also what has price shown me so far as the range, like for instance, okay, let's break it down like this. Understanding support and resistance is huge, and understanding where the price has made tops is also huge, and where the price has made bottoms. Okay, so kind of like understanding your highs and your lows. Okay, let's just say. Okay, this one went below here, but understanding that relatively this is kind of in a range right here. Okay, now when I look at what happened between this point here, let's just explain it like this first. The market, read the market. The market came up, it got rejected, right? It came down in here, but it made what? A higher low than over here. Okay, so the market made a low here, but this low here was higher. After a rejection, so the market came up, it got rejected. Came down here, but it made a higher low, and then it came up, and it went higher. So when we look at that, the market did not, what's very important to understand is that this move right here, after the market got rejected, right here, it did not drop lower. It's very important to understand the structure, reading the structure of the market and the price action, and also what the market's telling you. Okay, so this is a very important higher low that got put in here because it stopped the market from going lower after a key rejection over here. So between these 2 points, I have some interest. I want to know I'm gonna want to read the emotional structure that was left behind with Fibonacci. Okay? Now, if I take from this high here and pull it back, okay, to that low, I'm looking at extensions. Okay? Extensions. Let's pull it over. Okay. These Fibonacci extensions both served as targets. Actually, here, this one went a little bit higher. When we look on, like, let's say, Bitfinex, the same exact structure. The other one wicked a little bit higher because maybe there was somebody had like a limit order there or something like that. But generally, most of all these exchanges, from this point here to this point here, you have to understand that's it. The emotion changed in the market. This market did not get rejected and go lower. It found support, so therefore, it went to an extension higher. Okay, here and here. Both of those got dead on, the 1.272 and the 1.618. Okay, understanding that, just break it down like this for people. Let's get a blank chart. Okay, if price is coming on like this and it breaks out, right? If it holds a retracement, we're looking for to buy a retracement for the price to go higher, right? So therefore, we'll be looking to get a good retracement level for a buy entry, okay? But if price is doing this and it makes an impulse up and that impulse does not hold a retracement and goes lower than where it started, we are therefore looking for an extension in price. Usually, same thing, the 1.272 or the 1.618. So to understand the balance of what's happening there. So the market makes an impulse if it's going to continue up, right? The market makes an impulse. Either way, let's do it to the downside. Market makes an impulse down, right? If we want to sell it, we're looking for a retracement back up for us to catch a sell for it to continue down. If the market does not do that and it goes higher, then we're not looking for, we're not looking for that retracement level anymore. Okay, we're looking for the extension above. Now, for me, a lot of people use, basically over here, a lot of people use like retracements for your retracement, and we'll use trend-based extension for the extensions. I found out a long time ago that it's all the same. It doesn't matter. For instance, look. It all matters on how you have your Fibonacci's set in your settings. So if I have, let's say, come over here a little bit more, want a higher time frame. Okay. All right, so I could do it this way. This. And then back. Wait, that's. Didn't switch it, did it? There we go. This way, and then pull it back up. See, I haven't even done it in that long. Sorry, it's this way. This way to here, and then pull it back. But it's the same, basically. It's the same 2 points I'm measuring. So why do I take an extra step and do it with the trend-based, right? I always have found that if I just put my Fibonacci numbers in there, I can get both my retracements and my. Okay, just choose your style. I can have my retracement numbers in there and my extension numbers. You can even set a template and just have your extensions or just have your retracements. So play around with these things, find out what's comfortable for you, right? But people asked me before, why am I doing extensions without the trend-based extension? Because you really don't need it. Simple as that. All right, so look here again. Look at this move. Right from here. If you guys did it on a harmonic scanner, this market made basically a nice harmonic right in here, and then it went up from that D point. Measuring the C to D extension, okay, from C to D right there. Look at also again how these Fibonacci points here, 1.272. This one wasn't so relevant because the market went up higher. 1.618, dead on. 2.272, dead on. 3.272, dead on. Dead on. To every single place where the market ran out of greed, in a sense, and the fear started to kick back in, was at a Fibonacci extension point. Every single point. Okay? Now, check this out. If we measure here, okay, this market put in a nice base right here. We just talked about the harmonic pattern, and then boom, the market went up, right? When it came back down here, if it was going to continue up, then here's where we're looking for what? A retracement, right? For the market to go higher, right? But the market didn't give us that. Let's measure it. From here to here, I would be looking for about right in this area. If the market was going to go higher, this is where it should have held. But it didn't. It didn't. It did not retrace. It failed. It went lower than where it started, right? Okay, so this started here, came up here. It didn't hold a retracement. It went lower than where it started, and wow, look where it hit. The 1.618. Again and again and again and again and again. Fibonacci is going to be super relevant in your analysis of understanding, but you want to not just apply it blindly. You want to apply it with the understanding of where's the loss in the market. Where's the loss? If this market, you could play this over and over again. If the market makes a low here, and then the market starts to go up, okay, and then it fails a retracement and it starts to go lower than where it started, then you're almost certainly looking for it to fall to an extension of that failure down in these levels, the 1.272, 1.618. Over and over again. It doesn't matter what market even. I mean, I'm pretty sure if I were to look over here, let's look over here at plus 30. Rid of everything here. Let's look at the last move. Basically, this move. So up there, it didn't hold a retracement. So far, I showed some interest here. 1.272, 0.618, 1.272. Didn't fall all the way down there. So in here, just even looking at that, this market might now want to fall down to here and find support before it actually goes higher. Okay, where is the market looking to run to with a Fibonacci point of extension, or where is it looking to fall back to with a retracement? Okay, these Fibonacci points are extremely relevant over and over again. I just realized I only got like 2 more minutes here. I'm going to seal it up with this. Moving averages are super important. Okay, let's go back to Bitcoin here. Let's get rid of some things. I would say the most important average that I have found that I use in every time frame for me is where is price in relationship to the 50 exponential moving average. And for me, that line is yellow. Okay. The moving averages, you know, people look at all of them. They look at the 10, they look at the, I use the 4 also for smaller stuff, but understanding that every moving average is going to serve a purpose in your analysis. But for me, I found that I'm repetitively always trying to really understand where price is in relationship to the 50 exponential moving average. Okay, doesn't matter the time frame. It's a good sign of the market finding support or finding resistance. Okay, it doesn't matter if, like for instance, right now on the 4 hour, we're below the 50 EMA, so the market's looking weak here. I wouldn't really feel like we're gonna get strong again to go to, let's say, 8,000 until first I see us supported above the 50 EMA. right? Here on the hourly. Same way, so look. All through here, market is holding support in the 50 EMA. As soon as it lets go of the 50 EMA, it's dropping, okay? Now, this market will most likely try to at least come up here and test that 50 EMA. So if we see the market run up to 62.50 and get rejected at that 1 hour 50 EMA, then that's resistance for right now. And the market will most likely fall lower, okay? And even into the scalping strategy that we have with the scalper, it all really comes back to where is price in relationship to the 50 EMA, basically. Once there's a trade that is called based on the momentum of the market, we really want to observe, has the price, is it trading above or below the 50 EMA? So if this thing were to call a buy right now, it wouldn't, because there's no parameters to be met. But let's say that it comes up to about 61.50, right? And it calls a buy over the next coming hours. What am I really looking for to make sure that price is going to keep going up? I'm looking for two things. I'm looking for a break of structure. So basically I want to see all of the price start to close above all of these highs and actually put in a higher close. And I want to see that it puts in that higher close and closes and starts to close and stay above what? That 50 EMA. Super important. Super important. Nothing is going to change in this market until, like for instance, like this market here is not going to go up until it crosses the 50 EMA and turns that back into support. If we keep losing the 50 EMA and we keep tagging it like we're doing here, where we keep tagging it and not really closing above it, all through here, if we keep tagging it and not closing above it, the price is going to continue down. The moment that the price gets stable above it and starts to close back above that 50 EMA, and it starts to move away from there, then you put your risk under the bottom and you're looking for a buy to the upside. So understanding where price is in relationship to moving averages is also super important. And then when you can line that up to a retracement point or an extension point, or also get into the momentum of the market when you want to take the trade, those are the things to really look for. Is what's the market doing? Like, where's the loss? Is the market going to make a retracement? Is it going to go lower? Is it going to make an extension? Is it going to run past where it started? Where is it in relationship to the moving average? And the one thing I don't have time to cover here on this session is what's the momentum of the market? What's the momentum? Because if there's no momentum in the market, then there's no flow. The market's getting weak. It's most likely going to drop. If there's strong momentum, the market's getting strong, has the potential to continue up. Okay, so understanding all of these things, I talk about a lot more in depth of how to use different strategies to enter the market and stuff like that on my Go Live sessions on my channel. But I wanted to spend a little bit today covering just a couple different things for people to really grasp. First off, understanding what's happening in the world right now. All right, how that's affecting the market, how that's creating opportunity and volatility, and to know how the money's flowing and what markets affect the others. To understand how you want to trade it, what kind of trader you want to be. Like how long do you feel comfortable taking a trade? How fast do you want your profit? How many times do you want to take a trade? You really want to get in balance with all those things. Understand risk to reward setups and understanding how long you want to hold a trade to decide what kind of trader you really want to be. Then understanding that the markets are just cycles of emotion. Understanding where the loss is to understand where you're going to win in the market. Understanding that Fibonacci maps out the markets for us. Fibonacci maps out the markets for us because it's reading the print left behind by human emotion. It's the only way I can describe how it works. It's literally we're measuring human emotion when we trade. We're trading human emotion when we trade. Trading is just a transfer of value from the impatient people to the patient people. That's it. That's it. If you can understand these simple concepts and then apply some technical analysis and the things you grow along the way, then hopefully the things that you get out of the session are like cheat codes of things to understand the way to look at the market. Don't just look at it like raw technical data. Look at it as a cycle of emotion, always, always, to try to understand and study where the loss is. All right, so we'll see you guys potentially on another Sunday session. Come check out my sessions Tuesdays, Thursdays, 2 p.m. Eastern on the SwipeCoin DCX channel. And guys,